Okay, hello everyone. My name is Mark Maimon. I am a vice president at Luminate Bank, and I do residential mortgages with a specialty in lending to seniors in all sorts of creative ways. And I have been in the mortgage industry for almost 25 years. So I've seen a lot of the ups and downs and helped a lot of families navigate the challenges of paying for the rising cost of care. So Christine, I appreciate the opportunity to be here today.
Yeah. So, what are some creative ways that seniors can finance their care? Because there's still a lot of skepticism around reverse mortgages, but I
Mhm.
feel like there are new programs that are popping up every single day that folks should know about, especially if maybe the adult children only need a little, maybe a couple $1,000s extra a month to pay for
Mhm.
mom's care versus sell the house, get hit with the capital gains. What's out there? What do we not know about that we should?
Yeah, for sure. Well, you hit the nail on the head. Reverse mortgages have always been the industry standard for seniors. Whenever people think about financing for seniors, it's always a reverse mortgage because they don't know that there are other alternatives out there. And there's pluses and minuses to reverse mortgages that we can get into later if you'd like. But some of the alternatives are just variations of programs that fit the needs of seniors like a glove. And I'll give a quick example. We've had clients who just wanted to pull out some equity from their home to pay for future needs of care. So they didn't actually have an immediate need for the money, but they wanted to have access to some of the equity because they knew that working with their financial advisor, there just wasn't going to be enough to pay for the future care needs. So one of the solutions that we have is a line of credit, a standard home equity line of credit, but has a very important niche characteristic to it in that it will, in addition to using income to qualify, which is how most underwriters of residential loans will base their approvals on, it also allows us to use the assets that they may have in, let's say, an IRA or retirement account to add additional theoretical income based on how much they have in those accounts and how long they might take to utilize it. So, without getting overly complicated, I'll give you a quick example. We had a client with about $350,000 in an IRA, and we were able to convert that into an additional $10,000 a month of qualifying income, which was all the difference she needed to be able to qualify for that type of loan. Whereas otherwise, she would have been denied for that financing and actually had been a few times already before she contacted us.
Yeah.
So there's lines of credit. There's also creative underwriting criteria where you might not need to disclose employment or income. And income is the biggest problem for
Yeah,
seniors.
they're on a fixed income. They're on a
Yeah.
fixed income, maybe a small pension and a little bit of Social Security.
Right. And that's it. And that's hard to qualify for a mortgage. And when you're talking about the current rising cost of care, you can only take out 50,000 sometimes. It's not going to last you very long. And so oftentimes people end up selling their homes instead of financing them, and they end up incurring capital gains. And that's a whole other issue and topic of some of the strategies that we use are actually for tax planning, even more so than paying for care.
Yeah. Okay, so let's get into at least give me the do's and don'ts or the benefits and not so good benefits about a reverse mortgage.
Reverse mortgage, sure. So, in my opinion, the best use of a reverse mortgage is when you have memory capacity issues.
Okay.
Reverse mortgages are far more accommodating of people signing on behalf of the senior, meaning a power of attorney.
Yeah.
So if you have a senior with memory challenges and they're having their, whoever it is that has their power of attorney to sign for financial documents for them, reverse mortgages are more friendly to that. The reason being more traditional loans, there's a big concern about equity theft from seniors and them being taken advantage of, especially when there's a memory care issue and they don't really comprehend necessarily what's going on, banks don't want to be party to a family member who may not be looking out for the best interests of the senior, taking out a loan and then using that money for themselves,
Yeah.
without the senior really knowing about it. So memory care issues are where I think a reverse mortgage can be a great solution, but it's not without downside. So my biggest issue with reverse mortgages is that the best thing about reverse mortgages is that you don't have to make a monthly payment.
Hmm.
And the worst thing about a reverse mortgage is that you don't have to make a monthly payment. And that's exactly the same thing. It's the best and the worst at the same time. The reason it's the worst, obviously, the best is the obvious one. You're not paying out of pocket for that monthly payment. The problem is that by not paying for that monthly payment, what you're doing is stacking old payments that you theoretically should have made on a mortgage, maybe a year ago, 2 years ago, 5 years ago, and all that interest has added up because you're not making the payments to actually pay it. So what's happening is your loan balance is going up and you're paying interest on interest that you didn't pay years ago. So what happens is that compounds against you at a more rapid pace the longer you're in the loan because you have more and more deferred interest that you didn't pay in the past.
Yeah.
So you accelerate the pace at which you lose equity to the bank. So that's my biggest issue. That is probably the most impactful one that people don't necessarily fully understand. It's the opposite of investing money in in a stock account or bonds where the gains are working in your favor and compounding work is working in your favor. In this case, it's working against you at an accelerated pace.
Yeah.
The
What
other
are
thing
the
is yeah,
minimum,
I'm sorry, go ahead.
what are the minimum equity limits that somebody would have to have on their house still to even qualify for a reverse mortgage? Is there a standard or is
Yeah, it depends on the program. There's a few different ones, but I've yet to see many that will go beyond 60% leverage of your home. Usually it's 40 to 50% for most.
okay?
So it's pretty limiting, especially if you already have a mortgage in place,
Hmm.
to then replace that with a reverse mortgage or to try to pull out some additional equity. Some of the other programs we have will allow you to finance up to 90% of the value of the home. Not that you want to overextend by any
Yeah.
means, but sometimes that's what's needed to pay for the care. Um,
What
so,
happens when you've tapped out of all of the money that you've borrowed against the house?
well, if it's in a reverse mortgage, what happens is you just can't draw any more money and you end up having to come out of pocket for payments.
Can't kick
But
you out. You still have to pay your property taxes. Like, how does that work?
yeah, exactly. You've just basically tapped out the amount that you can borrow.
Okay.
So what do you do if you can't borrow anymore? Which is basically when you're borrowing, that includes not making the payments. What you're doing, you're technically borrowing the payment from
Yeah.
the lender. So once you hit that, you're out of luck if you aren't looking at a different type of loan at that point. And lenders aren't going to go, for example, in second lien position behind a reverse mortgage. That's typically not allowed. So what would have to happen is if you're in a reverse mortgage and you hit the cap, you would potentially have to refinance out of that loan into one of the other programs that we have. But the idea is that if we get in touch with people early enough, they're taking these types of programs before they take the reverse mortgage, so they're not in that situation where now they've capped out on the equity that they can draw and now they need to go back to the well, so to speak.
Oh, wow.
So that comes in the planning up front that we do with families to try to navigate that and figure out exactly how much they need to pay for care over time. We generally recommend that they overestimate because people are living longer. The cost of care might not be the same 5 years from now as it is now. So you kind of have to account for all these things when you're planning with a family.
Oh, yeah. And people are living a lot longer. And just with all the new regenerative medications and all the peptides and everything, we're going to be living a lot longer for sure. For sure.
Yeah, knock on wood. Let's
Yeah.
hope that we have that problem.
As long as we're healthy. Yeah. Because in-home
Exactly.
care, I'm seeing throughout at least the Bay Area, $45 an hour, and most places want a 6 hour minimum per day. And that
Yes.
can get pretty costly fairly quickly.
It can. If you're looking at about 8 hours of care, if you divide it into thirds of a day, 8 hours of care will cost you somewhere in the range of $10,000 a month. So
Yeah.
if you need 24-hour care, you're easily into the 30, $40,000 a month range. That's post-tax money. And look at that over the course of even 3 years, you're talking about $1.5 million for the home care, for 24-hour care. It's very expensive. That's why, some people have the means to pay for that out of pocket and they've planned and maybe they have a long-term care policy that helps with some of it. But a lot of people are in a situation where their biggest asset is their home.
Hmm.
And ideally, you want to leverage the home before you sell it because if you sell it, then you might end up paying a pretty substantial capital gains tax bill.
Yeah.
So, it depends on every family's needs. They're all different, but taxes are something that people, I think, need to be more mindful of than they might be on initial thought.
Yeah. So how would you solve for a scenario? I'll give you a scenario. This
Sure.
is someone I have right now.
Let's go.
92-year-old man. He's a limited fixed budget. I think he only gets Social Security, probably about $1,800 a month. His
Mhm.
house is paid off. And it's probably, there's some delayed maintenance. It's probably a little hoarded.
Sure.
He needs capital to even get that house ready to be sold. Because what I don't like to see happen is, uh, these cash offers that just, will give you the
Hmm.
lowest dollar amount. We need these guys to get the highest dollar amount. So get that house ready to be sold, spick and span, and all that good stuff.
Sure.
How can you solve for clients that are in that situation?
Yeah, it's a perfect situation for a bridge loan. So, bridge loan is designed to be a short-term financing solution. Doesn't necessarily have to be, but in most cases, that's the design of it. And what it does, it gives you capital to pay for, I assume he's going to be moving into some
Yep.
sort of
Moving into assisted
community
living.
or
Yeah. Mhm.
facility. So it can be used to pay for whatever let's say the first 6 months. If you need time to, if it's hoarding, it's probably not going to be a snap your fingers in the places show ready to sell.
Yep.
So you give yourself some time to pay the rent that you might be paying at the new property. And the cost of renovations can be included in that bridge loan. The cost to carry that mortgage for as long as you think you will need it. So all these things could be combined, and then we usually recommend a little bit of a cushion just in case something unexpected happens. But a short-term bridge loan would be perfect for that because it solves all of those needs. But most importantly, it allows the senior to be able to have the money that they need to move into the new community because they're not going to let him move in for free for six
Yeah.
months until you sell, right? So the key is the bridge loan allows somebody to move out of the home first so that you can do all the things that you know you need to do in order to sell that home for top dollar, do the repairs, get rid of the green carpets, whatever it may be, and then get that place show ready. And then you end up usually making more than what you spent on the bridge loan in proceeds from selling at a more, opportune condition of the property.
Now, is that I have to run a credit report and is it all tied to that or is it just tied to the equity in the house? How does the qualification
Different programs work differently. So some of them where a senior just doesn't have any means to qualify for a more traditional loan, that's fine. We have some that are just based on the equity of the home. It's not a problem. And they can use that money as they wish. Others will have a little bit more underwriting where they might look at the Social Security income, maybe any assets that they have, like some, general qualifications. Others may not have any requirements as far as the cash out of pocket or income. And some of them even have a situation where they don't require any monthly payments for up to 6 months. So
oh,
that's helpful, when you're transitioning into a new home, they'll defer the payments to the end when you pay off the mortgage after you sell the home. So there's lots of different variations. The terms get worse as you get further away from the what I call the center lane of underwriting, where you're documenting traditional income and money in the bank and good credit and all those types of things. As you move into the loans that don't require any underwriting at all and they're just based on the equity of the property, those get progressively more expensive. But those options are there, and oftentimes, unfortunately, those are necessary for seniors who are trying to make that transition into a senior living community.
So what if the property is already titled in a trust? Does that make any difference?
In some cases, it can be better.
Okay.
One of the products that we have is what we call a trust loan, where the loan is done to the trust itself.
Okay.
The house is still used as collateral, but the reason why it's given to the trust is what we call a non-recourse loan, which means nobody is personally signing on this loan. So you don't have a senior trying to qualify. They're not looking at tax returns. They're not looking at bank statements. Or not even looking at a credit report. They're just basing it off of the equity of the home. And the trustee of the trust is usually the one that signs to acknowledge that the loan is being placed on the property, but there's nobody personally liable and therefore nobody personally underwritten by a bank to be able to do that. So estate planning is a really critical factor. This is one place where it can really help, where it can open up that trust loan. Whereas if the senior doesn't have a trust set up, they may not be eligible for that type of loan.
Got it, got it. And then is there any caps on what can be taken out on like a trust loan? Like let's say I have a
Yeah,
trust for my grandmother's, her house is in a trust, I'm the trustee, and she needs care, and I don't want to do the reverse mortgage. And maybe I just need to supplement a couple of $1,000s each month because
right.
some other things in place. Is that a loan that I can take out against the trust in the future?
Potentially. But keep in mind the collateral is the property itself, not the trust assets
Correct, correct. But the house
outside of the
is in the
property.
trust, titled in the trust.
Right. So
Okay.
that would depend on whether the senior is remaining in the home for home care or if they're relocating to a community. So trust loans generally don't want the senior to still be living in the home.
Oh, okay.
And to be honest, a reverse mortgage might be a better solution in that case, in that
Got it.
example. If the senior is staying in the home, one of the biggest issues with reverse mortgages that we didn't talk about yet is the requirement that people have to stay in the home for as long as they keep that loan. So if they've lived at home for 5 years on a reverse mortgage and then the care needs change or they need to move into a facility or they need skilled nursing and they're going to be there for a long period of time, they're actually required to pay off that reverse mortgage.
Yeah, the
How do you
notice
do
due,
that?
right?
You don't
Yeah.
have the means. How do you do that? You end up having to sell the home, and then you might trigger all the capital gains tax and all the things that you've been trying to avoid all along.
Yeah. But if you've already, have a huge loan against the house and there's not much equity, you still get hit for the capital gains of the value of the house.
Yes,
So
the capital
if
gains are
I borrow
irrespective
against the
of the
whole
debt.
$1 million, right? And let's say with
Yes.
my mortgage and a reverse, I will still get hit with capital gains, even if I don't have it.
Correct. People oftentimes think capital gains tax are based on how much profit you get
Yeah.
from when you
Yeah.
sell the property. That's not how it works. It's the basis, which is typically what you bought the home for. You can add, I mean, without getting too technical, you can add in the cost of renovations or additions to the home or whatever you've done over the years and the cost of selling. But capital gains tax is, if we simplify it, just to keep it really simple, is based on the price you paid for it when you bought it and what you sell it for.
Mm,
Doesn't matter how much debt you took out against it. That's not the IRS's problem, because debt is tax free.
yeah.
So when a senior passes away, what happens is there's a what we call a step up in basis, which is where the value at which the IRS compares your sale price to is no longer the date of acquisition, it's the date of death. So if you sell the home a day before a senior passes away, you might have $1 million of capital gains tax in a more extreme example. Whereas if you sell it the day after, there could be zero. So tax planning is really, really critical. And every situation is different. I'm not a CPA, so I'm just giving you my own insights here. But people often underestimate the implications of capital gains tax and how to properly quantify how much you actually might have to pay.
Yeah.
So if you over leverage your house to, let's say it's a, keep numbers simple, $1 million home and you leverage it to 90%, doesn't mean you're not going to have a $200,000 capital gains tax bill if you sell that home while you're still alive. You have to figure out how to come up with the difference. And
Oh
you got
yeah.
to pay, you got to pay the agent, you got to pay the transfer taxes, you got to pay all the other expenses. So
Oh,
you
wow.
don't want to over leverage yourself, number one. Number two, you want to make sure, this is a big thing for me, is to make sure that seniors and their families are engaging with all of the professionals that can support them, estate attorney, tax accountant who can comment on the taxes, financial advisor who can tell them, okay, if you pull out equity from your home, what can you do with it in the meantime to help it last longer?
Yeah.
All these things are relevant. We don't want to be giving people advice in a vacuum, and then all of a sudden they get a capital gains tax bill that they don't have the money to pay for because they over leverage their home.
Yeah, yeah, exactly. I know. So it's that's what I tell families all the time. If you're going to be selling the house, chances are mom and dad will probably be in a little bit more stable environment. A nurse on staff is going to be monitoring intake, output, medication, all that stuff. So they could potentially live longer. So don't pick the Ritz-Carlton of senior living if that one asset is going to be paying for your loved one's care, because
Right.
7 years could go by quick and they're still kicking. And where's the money coming from?
Right. And the hope is that, when we talk to seniors, a lot of times they're very focused on the legacy planning. What legacy am I leaving behind? Which is usually the home, because the home is an emotional place. There's emotional connection to a home more so than an IRA account. Right. So oftentimes they're thinking about, well, I don't want to leverage my home because I want to leave it to my kids or something like that. Sometimes the kids don't even want the
Yeah.
house,
Or the
but
contents in it. They're like, nope,
right,
all the
exactly. Or the taxes that come with it, or whatever it may be. But these things are all important, when planning with a family and having all the different professionals on the real estate side, tax side, estate planning, mortgage, all of these things coordinating together. You're going to get a far better result that doesn't miss some small but very important detail about how this is all going to play out.
yeah. Now, how soon do you think folks should start thinking about this?
Before there's a crisis. That's usually the problem that we run into, where financing in a crisis is more difficult and generally more expensive because there's
Oh yeah,
less options to choose from. So
100%.
yeah, it makes a big difference. So, for example, if you are planning, for future needs, we had an 85-year-old client recently who wanted a line of credit. It was the same example I gave earlier. She didn't have an immediate need for the money. She was living in the property and was perfectly fine, healthy at 85. Knock on wood. Hope we're all as lucky. But her and her financial advisor were planning ahead for the future care needs that could have been 10 years down the road. So in that case, we opened up a line of credit. Why a line of credit? Because you're not paying interest until you actually borrow the money. So
Mm-hmm.
you have access to the equity of the home without actually having to pay monthly payments on it until there's a need to actually use it. And because you only pay for whatever amount you've drawn at any given time. So if you draw 50,000, you're paying interest on 50,000. If you borrow another 50,000, then you're paying interest on 100,000 that month, but you're not paying interest on the full lump sum from day one when you don't have an immediate use for the money. So I'm a big proponent of people opening up a line of credit just so they have access to the equity. Sometimes you need it quickly without any advance notice. And if there's a medical challenge, good luck trying to get a loan while you're, being admitted to a hospital.
Yeah, yeah,
It's not easy to arrange everything, and you have all sorts of logistical problems with trying to do that.
yeah.
So my general advice is do not wait for the crisis. Plan ahead. This is why the financial advisors are really helpful, estate planning attorneys. But in my opinion, this goes for seniors and, to be honest, anyone else. There's very little reason to not open a line of credit on your house.
But is
If
it tied to the rate at the time you open the credit, or is it variable? So if I borrow 50,000 today and today the interest rate is 6, and then I
Mhm.
borrow another 50 and it's, I don't know, 7.5. Is it
Mhm.
variable? How does that work?
Yes. So a line of credit is typically based on the prime rate. So right now the prime rate is at 7.5. As the Fed
Ooh,
lowers
when is
interest
that coming
rates,
down? When is that coming down, Mark?
as
Is
soon
Jerome
as
getting
the
fired?
Fed
What's the word on the
Yeah,
street?
that might. If Jerome gets fired, who knows? Maybe the next person will drop him by 2% the next day.
Yeah.
But as the Fed lowers rate, the prime rate follows suit to the same degree. So if the Fed drops rates by 0.25%, the prime rate will follow suit, drop by 0.25%. So we're still in a pretty high rate environment because of inflation, all these other things going on right now. And so if you took out a line of credit right now, in all likelihood, a year or two from now, you're going to be paying a lower rate on that same money. So it's not tiered where you borrow the first amount at 6% and then the going rate's 7.5%. So the next $50,000 that you borrow is at 7.5%, whereas the first 50,000 is at 6%. It's a blended rate for all of it that goes up or down depending on where the prime rate is. But the flexibility that you get with that type of loan, especially when you're planning for a future need that you can't even really predict,
Mhm.
you may not even know if you want to do home care or if you want to move into a facility or if you just need money to pay for care for a period of time. You really don't know those things ahead of time because as much as people try to plan, sometimes circumstances dictate how you need to take action.
Yeah, absolutely.
Um,
So for my
so
Gen Xers, can I borrow against crypto?
I only do mortgages, so I can't answer that question.
All right. I wonder in
I
the
can
future.
tell you mortgage lenders have not fully caught up to the crypto craze yet.
Wow, wow.
It's probably coming, that's becoming a little more normalized where some of the programs start to sprinkle in some guidelines of how to use it,
Yeah.
but it's not fully accepted quite yet.
Oh yeah, I remember I got my first tax paper saying how much crypto did you buy? Because I'm a early adopter of 2017 and I rode that wave for quite some time. I
Good for
probably pulled
you.
out a little too early and now it's like and I'm like
Right.
I told my husband people on Reddit were saying it's going to go up to 100,000 and he was like, "Yeah, right. Look at this. This is too volatile. Get
That'll
your money
never
out."
happen.
Yeah, now look at today,
Right, exactly.
but we shall.
Well, yeah, if you get in at the right time with those investments, you can do very well. But, and you're in it, but that's from a different phase than when you're planning for senior care. Senior care, you need your money to last as long as possible, so you probably take less risks.
Oh yeah.
If you're managing your risk accordingly, because you don't want to also lose value, you need the money to pay for your
Oh, for
care.
sure. For
So
sure.
totally different strategy for seniors than for other people that can take more risk because they have more time to allow the ups and downs to happen.
For sure. I get the calls, the frantic calls of the adult daughters that they don't even know where to start, what their parents' finances look like, how are they going to pay. And now, ninth hour, they're getting the call from the hospital saying, hey, you got to make a decision by Tuesday.
Right.
Those are some scary places to be. And so, me, I'm only 43 years old. I am already meeting with my financial planner. We just met with them on like the 11th to plan out how do we get to $2 million so our kids never have to worry about us.
Right.
So,
Yeah.
because I think that
You
that's
made a
about
good
what it's
point.
going to take. It's in the future, you're going to need $2 million if you want to stay in America.
You're probably right. Yeah. You're
That's
you're
my guess.
probably right. And that's a lot of money post-tax. So if you don't plan from when you're in your 40s
Yep.
for your 80s and 90s, you got to make some pretty good decisions on crypto and other things in the meantime to be able to get there.
Yeah.
Maybe real estate, who knows, whatever your choice of investment is. But the longer you wait to plan, the more pressure you put on yourself to be able to do it in a short period of time. And investing, it's same with real estate investing and just about anything. The longer you're in it, the more you benefit from it. And again, we talk about compounding. The investments compound and grow, growth on growth. That's how you create wealth.
Yeah.
And that's why I don't love reverse mortgages for that reason, because of compounding against you as opposed to for you.
Yeah. Yeah.
But the key is to plan long term. One way to do that is to actually borrow money and use that to gain equity and value over time by investing it, and compounding over time usually outpaces the cost of the actual interest on it
Yeah. Now, are there
within
limitations
reason.
on what I can do with the money if I decide to live in the house? Like, let's say I need to remodel a bathroom ADA.
Mhm.
No.
Totally fine.
Okay.
We have like a HELOC would probably be a great solution for that. again, we recommend opening a line of credit for more than you think you need because you need an ADA compliant bathroom now. Maybe 6 months from now, there's something else that you need to do to the home. Maybe you need to put in a ramp. I mean, it could be anything.
Yeah.
Um, or maybe it's not even necessarily something related to your home, but just an expense that you have to do, or you want to stay at home and all of a sudden the roof is starting to leak and now you got a $25,000 roof project that you weren't planning on, or you got roots growing into the sewer line.
Oh God.
Who knows, it could be anything. But that's why a line of credit is great because it gives you access to the capital without actually having to borrow it. So on a moment's notice you can take out a checkbook from your drawer and write a check for the ADA compliant bathroom and the ramp and the roof all
Yeah.
in one day without having to wait for a new loan to come through, which can take, 30 days or so.
Are there any questions that I haven't asked you in terms of how you serve seniors and this particular demographic?
I think the one thing I can't underestimate, that people often underestimate, is the implications of capital gains tax.
Mhm.
That, and I know we have talked about that, but sometimes what happens is the loan can be used as a means to buy time so that you don't have to sell the home right away and potentially benefit from that step up in basis.
Mhm.
That is the most underestimated aspect because people don't see it on the surface. It's not like an expense like you go out and, buy a car and you got to pay for the car. It's like a hidden thing that's always lurking in the background, but people don't want to they don't know how to calculate it or they don't want to think about it. But before you're doing anything with senior living and making decisions if you're going to stay at home or move into assisted living or memory care, those are the times where you might naturally think, oh, I should sell my home and then I'll have plenty of money to pay for this. And that's true. But if you sell the home, you may also be giving, 30% of whatever you profit from it to the IRS. And I can guarantee you anyone would rather give that money to their family in an inheritance than they would like to give it to the IRS. And we've seen some very extreme examples up and down California, one of which in Orange County recently, where a senior bought their home for $20,000, sold it for 4.5 million, literally wrote $1 million check to the IRS at 97 years old, needing probably 12 months of care before, she would probably pass. If they had borrowed that money, maybe a couple 100,000 to pay for the care that she was getting in the new community and kept the home, even let it sit empty, vacant, no tenant, no nothing, they would have benefited $800,000 more to the family.
Yeah.
So those tax implications are significant, especially because the generation that's aging now is a buy and hold generation. Like I haven't owned my home for 50 years. Well, I'm only 47, um, but the generation that's aging now typically stays in their home for a very long time, which
Yeah.
is why you get the, needing to be updated and all that, not show ready, whatnot, because they've just been lived in, a lot of stuff accumulated over time. So this generation in particular is going to be subject to a huge potential capital gains tax because they've been in the same home for years and years. If
Yep.
you sell your home after 10 years, you might pay a little bit of capital gains tax when you sell it. Then you buy the next home, you accrue maybe a little bit more and then a little bit more, but you pay it over time. When you've lived in your house for 50 years, it's one big tax bill that could be coming at the end, and people oftentimes underestimate that. And that's where financing can be a tremendous asset, to be able to avoid that tax and take advantage of I wouldn't say the loophole, but the benefits of the step up in basis are significant, especially when you've owned your home for a very long time in terms of decades.
Yeah, yeah. And I always tell families, they'll look at these CCRCs and they're like, well, it's a buy in. And I'm like, yes, it's a life plan contract. It is not a traditional real estate transaction. As far as I know, and I don't know, Mark, maybe I'm wrong, but you're not getting a tax deduction for buying into a contract into a community.
No, I mean, I don't want to say officially yes or no, but usually the benefits are when you own real estate and you don't
Yeah.
own real estate when you buy into a CCRC.
Yep.
But bridge loans are a great solution for that, where you could pull out equity from your home to pay the entry fee.
Yep.
That's actually one of the most popular uses of our bridge loan product is specifically for CCRC entry fees because they're significant. They're usually 6 to 7 figures. I heard of one in Palo Alto that I think was up near 8 million.
But I believe it.
So, those they're substantial and they're usually a one-time flash in the pan kind of thing. And again, if you're tax planning, you may want to use financing against your home rather than selling it to pay for that.
Yeah.
Plus, most people prefer to be able to move into the new community that they're moving into, settle in, and then focus on the sale. And it's better for the agent, I would imagine, as well, to have a house that's not currently occupied to be able to sell it and show it all hours.
Now, are there any, just with everything that's going on in California and insurance, are there any barriers to getting any of these loans when maybe their insurance has been dropped?
Well, in order to get a loan, a lender is going to require you to have sufficient insurance to at least rebuild to the point where the lender could get paid back.
Okay.
But the lender, there's something called a mortgagee clause in the homeowner's insurance, which basically says that the lender has a claim to the insurance money if there were a problem, a fire or whatever it may be. So if you're self-insuring your home and then you go to get a mortgage, you're going to need to find a policy one way or another because the lender's not going to allow you to self-insure. No matter how wealthy you are, they're not going to generally allow that because they want to make sure that their interest in the property, which
Is
is the
here.
amount of debt that they're putting on you, is secure. Exactly.
Yeah.
The last thing they want to do is have the collateral vanish in a bad fire, or some other natural disaster, and now the lender's just stuck and they don't get to see their money back.
Yeah.
So self-insuring is a problem. If you go to take out financing, you're going to need to find a policy.
Yep.
If there's a policy, but it's just expensive, you can use the loan to pay the premiums if you need to over time. But that is the general issue that we sometimes see. Beyond that, as long as there's sufficient coverage, it's not usually a problem. If you take out financing, it's just, notifying the insurance company that there is a lender on board and they have to add a very simple mortgagee clause that has no impact on your actual insurance policy. It's very
Yeah.
simple
Yeah.
to do.
Wow. Okay. All right. Insightful. Anything else you want to share with our viewers here?
Yeah, I think just, do all your proper consultations, know what your options are before you need them, plan ahead, have the financial team fully in place. Don't wait for a problem to happen before you call the estate attorney, because at that point it might be too late where you can't even sign on your own.
Yeah.
Estate planning, very, very important. You do not want your property to end up in probate. Much harder to sell, much harder to dispose of assets, and you don't want the state determining what happens to you physically as well as all of your assets that you've accumulated over time. So planning is really key, understanding your options and staying ahead of the need. Where if you have a good financial advisor, they'll be able to tell you you don't have enough money to age, so you need to do something,
Yeah.
and then the planning starts. What do you do? And mortgage may be part of that, may not be part of that. But that's why we're always giving people honest opinions on what we think they should do. We have no problem telling people you shouldn't do anything. You
Yeah.
should just stay the course and do what you're doing and don't take out a loan.
Yep. Yeah. Agreed. Okay. So where can folks find you online?
Sure. So for seniors, we have a website, seniorfinancingsolutions.com. You can find all of our information there. It's a great resource with some videos and things like that we've created over time to help families kind of navigate these challenges, understand the options that are available to them, although they are all unique to each person's circumstances. So we might recommend one product for one client and another one for a different one. But seniorfinancingsolutions.com is the best place to start. You can initiate an inquiry, you can find our contact information, and have some great resources to help you navigate this.
Awesome. Thank you so much for your time.
My pleasure. Thank you for hosting.